You know, it's wild. I recently reviewed this business owner's books, and when I pulled up his balance sheet and walked the owner through everything that was off, he was angry. Not at me, but at the fact that nobody had told him that there were issues. And this was someone who already had a bookkeeper. Now, I'm going to show you 3 signs that your business books are in trouble, which may also tell you that you most likely need a cleanup, even if someone is already handling them for you. These signs are a lot harder to spot than you think, and they may cost you if you let it go too long. But before we get into the signs, I need you to understand something first, because without this, none of this is going to really make sense. Imagine you hire a contractor to renovate your kitchen. They show up every week, things are getting done, and it all looks great. Then a few months later, you notice a cabinet door isn't closing right. You look closer and realize the whole cabinet door is slightly off. It was never obvious, though, because it was so small and everything looked fine on the surface. The work got done, but nobody checked behind the contractor. Bookkeeping works the same way. Having someone handle your books and having your books handled with accuracy are not the same thing. And the problem is, it's really easy to assume that they are the same thing. So let's talk about what to actually look for. The first sign is that bank reconciliations aren't being done, and this one is huge. Reconciliations are basically the most fundamental thing in bookkeeping. It's the process of matching every transaction in your accounting software to every transaction on your bank and credit card statement to confirm that they actually match. And when that's not happening, you don't have a correct picture of what's actually in your accounts. You have data that someone entered but didn't verify. Here's why this one is so easy to miss. Most owners assume that if a bookkeeper is logging in and entering transactions, then the accounts must be reconciled. But those are 2 completely different things. Entering transactions and verifying them aren't the same steps. So the books can look done and still be completely unreconciled. And when reconciliations aren't done, the problems add up fast. Duplicate transactions, errors that just sit there and build on each other month after month. It also leaves the door open for things to slip through that nobody catches simply because nobody is checking those numbers against their statements. If you're using QuickBooks Online, you can pull up the reconciliation report for each account, and it will show you the last date it was reconciled. If there's no report for an account or it's several months behind, that's your sign that it hasn't been done. The fix is getting every account reconciled back to the last clean month and then making sure it stays on the monthly close checklist moving forward. The second sign is that transactions aren't being categorized correctly, and this one can sneak up on you because everything can look fine on the surface while being a massive problem underneath. Every transaction in your books gets assigned to a category. Things like payroll, rent, cost of goods sold, software expenses. Those categories are what build your profit and loss report, or income statement, as they call it in the accounting world. So if the categories are wrong, then your profit and loss is wrong. And if your profit and loss is wrong, you're making decisions based on numbers that aren't correct. Here's where it gets tricky, though. A lot of bookkeepers use accounting software automation to categorize transactions automatically based on rules that get set up. And that sounds great until you realize how broad those rules can be. Something like every Amazon purchase gets coded to office supplies. Okay, but what if that Amazon purchase was actually a piece of equipment or inventory or something personal that got charged to the business card by mistake? The automation doesn't know the difference. It's just following the rules. So the books look complete and tidy, but the categories are wrong, and now your reports are telling you a story that isn't accurate. And this gets even more common when business owners are doing their own books without really knowing what needs to be done. It's not that they aren't trying, it's that they don't know what they don't know. Things get coded to whatever seems close enough, and it builds up over time. The cost of this one shows up in a big way at tax time. Most tax professionals charge more when clients actually bring in unorganized or messy financials. So the money you thought you were saving by not staying on top of this monthly ends up costing you more than it would have to just get it right from the start. So how do you check this? Pull your profit and loss report and look at the category names. If you see anything vague, like uncategorized expense, miscellaneous expense, or ask my accountant, and there's a balance sitting in it, that's a sign something may not have gotten handled. Now, sometimes the Ask My Accountant one is usually used for asking your tax professional questions. And that could be the case in this situation. And also, the uncategorized expense account is usually used when the bookkeeper doesn't know where it needs to go and needs to ask the business owner that question. You can also dig deeper by running a profit loss by detail report or going through the general ledger, which will show you every individual transaction behind every category so you can see exactly what got coded where. The fix is going through and reclassifying what's wrong and making sure your chart of accounts actually reflects how your business spends money. The third sign is that your profit loss or your balance sheet has missing or unexplained items. Now, we already talked about how bad categories can distort your profit loss, so you already have a sense of how that can go wrong. But the balance sheet is where I want you to spend most of the time because it's the one that gets ignored, and it's the one that gets ignored the most. It's also where some of the biggest problems hide. The balance sheet shows you what the business owns and what it owes. When it has errors, they can sit there for a really long time without anyone flagging them because most owners never look at it. They usually check the profit and loss and move on. This is actually what happened in the review I mentioned at the beginning. That wasn't even a client of mine. It was actually someone who reached out, potentially looking for monthly bookkeeping services. But in order for me to do that, I had to take a look at his books. And when we got into the balance sheet, there were items that had been sitting there wrong for a long time. Balances that couldn't be explained, things that had never been questioned. This person was actively trying to bring investors into the business. So the stakes were real and they were immediate, which brings me to why this matters so much beyond just having clean records. If you ever need to get a loan or a line of credit or bringing on investors, or you need to verify your income, or at some point you want to sell your business, lenders and investors look at both reports, if not more reports. And if they can't make sense of what they're looking at, the conversation ends fast. Businesses with clean and accurate financials can usually get more money for their business when it's time to sell. Businesses with messy books may get discounted or the deal can fall through entirely. Even if all of that feels far away right now, the state of your records today is either building or eroding the value of what you've worked hard to create. So, how do you check this? Open up your balance sheet and go through every single line. If you see something that you can't explain, ask about it. Look specifically for anything sitting in undeposited funds that seems too high or has been there for far too long. Look for any liability that hasn't moved in months and that nobody can actually explain. And look for negative asset balances, but with one caveat here. Depreciation and amortization accounts are supposed to be negative, so don't let that throw you off. The owner's draw account usually runs negative on the books as well, but it can go back and forth. What you're really looking for is something that doesn't make sense and that nobody can clearly explain. And this brings me to something I really want you to take away from this. The review process cannot stop with just the bookkeeper or the accountant. It has to include you as the business owner, because nobody can care about your business more than you can. The IRS puts the burden of proof on the owner, not the accountant. So if the books are wrong, you are the one who is liable for the penalties and the interest, regardless of who is handling the records. That's not meant to be scaring. It's just the reality, and it should motivate you to stay in the loop on what your numbers are actually saying. So here's the thing I really want you to take away from this. Most of the time, when a business owner ends up needing a cleanup, it comes down to one of three things. Either they had no idea what was happening in their books because nobody was keeping them in the loop, problems just built up quietly over time, or they were doing their own bookkeeping without fully knowing what needed to be done and things slipped through the cracks. Or honestly, the books were just completely ignored and nobody was touching them at all. And that happens so much more than it should. All three of those situations are completely understandable though. Running a business is a lot, and the books can feel like the last thing to worry about when everything else seems to be on fire. But here's what I want you to understand. Letting it go does not make it cheaper. It makes it significantly more expensive. A cleanup will almost always cost more than regular bookkeeping. And the longer it's ignored, the bigger the issues can get. An extensive cleanup that covers months or even years of problems can end up costing several times more than a full year of proactive bookkeeping. And that's before you factor in what it costs you in bad decisions made from those numbers that are wrong. Clean books aren't just about staying organized. They're what you need to know your real profitability and make decisions that you can actually feel confident about. Your books are the financial foundation of your business, and nobody is going to care about that foundation more than you. Now, you know the three signs and why they matter, but knowing what to look for is only part of it. If you're not clear on who should actually be handling your books or what a bookkeeper versus an accountant is really supposed to do for your business, that's where you're going next. So click right here and I will walk you through it.